Hello, everybody. My guest today is Jonathan Treiber. He has championed greater measurement and accountability for online and offline marketing as CEO of Revtrax, guiding his company from initial product development to capital investment and continuous innovation. He leads a team of veterans and rising rock stars who today proudly work with more than 350 brands in numerous industries. Jonathan, you ready to take us to the top?
Sure. Sounds good.
All right, man. Tell us what Revtrax does and how do you guys make money?
So we're an 11-year-old startup. And our vision over a decade ago was to solve a problem among big consumer brands, retailers, consumer packaged goods companies that we believe were overly discounting and overly promotional. And the problem that we solve in the market is that a lot of these brands believe they're too promotional, and they want to discount less, but don't quite know how in order to leverage technology and a framework and systems to do that. And so we built a software platform that ultimately helps our clients figure out the optimal discounts to give to each consumer through their digital marketing efforts, in an attempt to honestly not give a dollar more than they have to a consumer to generate the sale. And so that's the problem. Ultimately, to enhance margin or reduce margin pressure that a lot of retailers and brands feel when they're discounting so universally.
So, Jonathan, if JCPenney had your software, maybe they wouldn't be bankrupt today then, right?
It's possible. Yes.
You can own it. You can say fuck yes. I mean, that's possible.
Yeah, right. It's very possible.
How do you price for something like this?
So our pricing model for now 10 years has been a volume-based SaaS. So what that means is our clients typically commit to a 12-month contract where they're committing to a certain level of usage of our platform, meaning a certain volume of offers that they want to create in a pool and optimize, a certain number of
offers distributed or offers actually cashed in?
Offers distributed.
Okay.
So the goal being a client might say, hey, Revtrax, I want to do over the course of my 12-month marketing calendar, 50 unique offers, X% offs, X dollar offs, buy one, get one, all these different offers they want to set up in our system and leverage our system to help basically figure out which offer to give to which person. And over the course of the year, they might say, hey, I think I'm going to do 1 million offers distributed or 10 million offers distributed. And what we'll do is we'll price the client in a tier where they'll commit to that level of usage. And if they go over, we'll bump them to the next tier and, prorate it. And if they use less, they're sort of, they're stuck with their committed
Jonathan,
tier.
You're a tough guy. No refunds if you don't use your what you fully paid for, huh?
Use it or lose it.
Use it or lose it. Like a good offer. Use it or lose it. All right. So give me, I'm sure you have tons of different customer cohorts here, but give me an average. You're on average. What's a brand going to pay you per year for this?
So a brand on average will pay us about $100K a year.
Okay. And generally speaking, if I pay you $100,000 today, what am I committing to in terms of offers sent over the next 12 months?
Probably somewhere in the neighborhood of 20 to 30 offers that we're going to manage in our platform for you over the course of the year, and probably 1 million offers distributed.
Okay, fair enough. Okay, and then you said you launched in 2007. Did I get that right?
January 2008.
Oh, 2000. By the way, hell of a time to launch a company. What were you thinking?
I wasn't. The thought actually was it wasn't based on macroeconomics. I came out of my first job at a Citigroup doing mergers and acquisitions. Before the whole Wall Street industry sort of melted down. So I felt like I got out at the right time, and then really wanted to start a business focused on, a problem I perceived in the market with my co-founders, which, has become more pervasive over the last decade with pricing and promotions being rampant. So I think we just picked a problem worth solving that actually was more acute in a recession than it was not. And so, believe it or not, I feel like the business we started and the problem we solved was actually more relevant in 2008 and 2009, versus in the boom years that preceded it.
Yeah, that's great. So, okay, so you've had 10 years to essentially 11 years to grow the business. What have you guys scaled to now in terms of total customers using you?
So we work direct with brands, so not through agencies, and that means that we today have 100 corporate clients at a corporate entity as customers, but underneath typical large company umbrellas, many of our clients like Kimberly-Clark and Unilever have dozens and dozens of brands, and so when you look at it that way, we work with 100 corporate clients that ultimately have about 600 brands active using our platform.
And how did you? How did you get? Take me back to '08, right? Because the first 10 customers are always the trickiest, right? What kind of mousetrap did you use to close the first 10 customers?
So yeah, I would say that the first 2 customers were the trickiest. Selling even the first customer before we had a product. The best story I could give you briefly is when we started the business in '08. Myself and my tech co-founder made a gentleman's bet as to who could finish first. Could I finish selling our first client before he was done building the product, or would he be done before I was done selling our first client? And as the story goes, we both finished pretty much in June of 2008, where we were able to convince the all-new CompUSA that had emerged from bankruptcy with a much smaller footprint, much more nimble team to buy our offer management platform.
Who'd you sell into there?
We sold into their marketing and merchandising team, and really from their big need was they had a much smaller digital footprint, and digital footprint. They had a lot smaller physical footprint, fewer store locations after they emerged from bankruptcy. They were a national chain, went bankrupt, had a much smaller footprint, and they wanted to use digital marketing that they had going on to drive in-store sales with targeted and trackable offers. And that was where we came in. So we were a good fit for what they wanted to do to drive awareness among customers, many of whom thought they were out of business. And what we found is in our first 10 customers, what all sort of seemed to be a common theme was that they were small enough to be able to make a decision and be nimble enough.
Quantify that for me. Less than how many employees or revenue, or what do you mean small enough?
So the best way to quantify it is they had a 10-person or fewer marketing team, and they had everybody kind of do everything. It was all in, very scrappy, nimble. Now on a revenue scale basis, those companies still did anywhere from 200 to 500 million in sales a year, so they were not small. But what we found is that we could get in front of the right stakeholders who can make a decision versus, of course, over the years, we've sold into bigger companies that tend to have much more silos and very different decision makers that can make the sales process a lot harder.
Now, have you chosen to bootstrap this company or chosen to raise capital?
We bootstrapped the company. So we initially did raised 1.6 million of angel capital from a bunch of industry angels who bought into this vision, and then ultimately we took that capital, invested it very prudently, and was able to scale the business.
So total raise today then is just that 1.6.
Yep, of equity capital, and scale the business to about 10 million of ARR with 55 and EBITDA positive.
That's great. Are you talking like seriously positive or basically break even?
Break even.
Okay.
Our focus has been to aggressively reinvest in the business for growth. And a lot of our contracts, you were joking about the use it or lose it concept of our contract, but one better than that is, like most SaaS companies, and I think you know this from your experiences, almost all of our clients prepay their annual contracts up front.
Yeah. You got to, you told me earlier, kind of average ACV is $100,000. So it's $8,500 a month across 100 customers, puts you at about $850,000 a month right now in revenue, or about a 10 million run rate.
Yep.
Yeah, that's great. Now, help us understand growth. So if you're doing $850 a month today, where were you about a year ago?
So we were about the same.
Okay. So we hit flat.
We're flat. Yeah. We hit some growing pains and hit the ceiling probably actually about closer to 3 years ago, and have been dealing with some macro things in our customer base that have created disruption for a whole set of vendors. But we've been working through some transitioning in our customer base and working out some client concentration issues. But overall, the business has continued to get stronger fundamentally. But as far as getting our sales and marketing engine back on track took some experimentation.
Are you, Jonathan, in any
year,
are you kind of in any M&A talks right now to sell the company?
No.
Well, it's interesting. So I'm curious, like, why you have the patience 10, 11 years in, now you're flat and you're basically bootstrapped. You could probably sell and get a nice chunk of change for you and everyone else at the company. Why have you, or have you considered selling, and why have you not?
So our POV is we have considered it, but that there's a lot of intrinsic value and trapped value in the company that I don't think is going to get sort of fairly valued with selling the business today versus turning it around, focusing, executing, getting the business back to growth, and then exiting over the next couple of years.
Yeah. Let me try and quantify that. So, I mean, if you had an offer today in front of you, all cash up front for call it 3-4x ARR, so call it 30-40 million bucks, would that be an offer that you'd consider strongly, or no, you'd reject it immediately?
I would consider it strongly.
Okay. So there's like some threshold of value you think is not unlocked yet. You think maybe 1x or 2x isn't fair, but once you start getting to kind of 3x, 4x, it becomes interesting.
Yep.
Yeah. Okay. Interesting. Talk to me about churn. It's critical in a SaaS company. What's your churn look like annually, and how do you make sure you keep it down?
So churn, ironically, was a much bigger problem for us in our earlier years while we were scaling and kind of taking new customers of all different types and sizes, only to learn that many of them were not our ideal client. Over the last several years, where we found churn to shake out is on account basis and a revenue basis. Account basis, our churn is a little north of 20%. But what that really translates into, when I give you the revenue retention, is we have a decent size of what we consider mid-market accounts that are between 20K and 100K ACV. Our enterprise accounts, which are about 30 of them, are all north of 100K ACV, and they tend to churn almost not at all. And so, on a revenue retention standpoint, our net revenue retention is about 95%.
Now, peel that back for me. Net revenue retention is made up of two components: your gross revenue churn annually, adding back your expansion revenue on top of that. So, can you give me those two metrics?
So, for probably worse than it is better, the two are the same because we haven't executed as well on expansion strategies and upsell opportunities. Mm-hmm. And so, when we look at gross and net, they're more or less within a couple percentage points of each other.
Okay, so hold on. You said net revenue retention is about 95%.
Yeah, and gross revenue retention is about 95%.
Okay, got it. So you're basically, what that means is you're not driving expansion on historical cohorts.
Correct.
Yeah.
Which has been an area of focus for us to turn that around this year.
Yeah, that's interesting, and that comes with like new product lines to upsell against, things like that.
New product lines, a new sales force that has the experience that we need in order to penetrate multinational accounts.
What's the current team look like today? How many people?
So the company is made up of 35 people.
Okay,
and we've got 6 people in sales and 6 people in client services, and the rest are distributed through product engineering.
And how aggressive are you being with like landing a new $100,000 a year customer? Are you comfortable spending kind of first year ACV on getting the customer in the door?
Yeah.
Okay, so you're fully weighted.
And our metric
could be $100,000.
Correct.
Yeah.
And and even a little bit less. I think it varies. It costs us obviously a lot less to win a more mid-market account that's paying us $50K a year in ACV. And then for some of the bigger ones, it could be more. But you're right. And our payback period is about 12 to 14 months. So, the metrics seem to pay out. The issue that we've had as a bootstrap company is lacking, the resources to be able to invest aggressively ahead of the curve. So, we've had to balance that over the last several years.
If someone hears this, even though you're flat, they're going to see you as non-fundable because you're flat, right? Which is whatever. But if you get a smart investor listening to this, they might see the upside. I certainly obviously see it. If someone came to you and offered you, $4 or $5 million to put in the company and asked for, call it, I don't know, whatever, 10, 20% of the company for that cash, would you take a deal like that or no?
Absolutely.
Yeah, because you'd fund that on like a new sales org, things like that.
Yep.
Yeah. Interesting. All right, let's wrap up with the famous 5. Number 1, what's your favorite business book?
I would say Good to Great.
Number 2, is there a CEO you're following or studying?
Hiroshi Mikitani of Rakuten.
At Rocket Internet? Wait, Rocket what?
Rakuten.
Oh yeah, Raccoon. Yeah. All right, number 3. How many hours of sleep are you getting every night?
6.
And what's your favorite online tool for building your company?
Mm, for building my company, I would have to say predictive index.
Yep, that's a good one. And then what's your situation? Married, single, kiddos?
Married, 2 young girls.
Oh, that's adorable. Okay, and how old are you?
I'm 36.
Last question, Jonathan. What do you wish your 20-year-old self knew?
How long it takes to build a business of lasting value.
Guys, they're basically bootstrapped, founded 11 years ago, $1.6 million raised. Today just passed $10 million in ARR, but they've been flat over the past couple of years as they look to kind of pivot and shift. The nice thing is they're doing this profitably. They're doing it up in New York, have about 100 enterprise customers, JC, big kind of retail brands that basically use them to do smarter offers and smarter discounts where they're not giving up so much margin. Again, growth, they're looking to refactor as they bring on a new sales team of 35 today as they look to scale 95% net revenue retention annually and $100,000 CACs on $100,000 ACV. So 12-month payback period there. Jonathan, thanks for taking us to the top.
My pleasure. Thank you.